If you plot gold in relation to the S&P, since the year 2000, it's been very zigzaggy, but it's been net up dramatically. Okay, gold is beat over that 20-year period, October 2020, October 2000 to this October, 20 years. Gold's gone up like 16-fold. S&P's gone up 4.5-fold, which is the better place. Yes, there have been some big bear markets in gold, also the stock market, but net on balance, gold's beat. Now, however, since its 2011 peak in gold, its spread versus the S&P also dropped, meaning gold underperformed the S&P during its bear market, 2011, 12, 13, 14, 15. Starting in about 2015, if you plot the spread, divide gold, ounce of gold into S&P price, and plot it month to month, percent, you've been in a basing range where at the top of that range, the gold performance will surge up to a given level and stop, come back up to a similar level, stop, and has built a beautiful trend line going back 11 years. We're only fourfold from our bear market low in 2015. So everybody's screaming how it's overdone. They're looking at arithmetic charts. They're not looking at logarithmic or ratio charts. We're in a somewhat accelerated price angle of ascent. You can see it on the charts. Silver recently nipped out its highs of the past 50 years. Gold's way above those, layer, breakout, layer, breakout. Silver still caught in its initial layer. We did a recent comparison in our weekly report showing a couple of examples of some base metals, copper and lead, for example, going back to the 1970s, where they were in ranges for decades, broke out, new reality range, etc. In fact, that happened for both of them in either 2006 for copper and 2007 for lead. What happened after they were in this boring multi-decade price range, an old reality, they quadrupled within a couple quarters. Again, at different times, so different situations. Quadrupled in price like a bomb had gone off. Okay? They moved out of their old reality into a new reality. And if you look at what's happened in the decade since, it's a new layered reality that's roughly 3 or so times the price level of the previous. How come silver is still caught in its old 50-year reality? Okay? Something's wrong there. You have to scratch your head and say, now maybe it's manipulation or whatever, or maybe it's just a market made a mistake. We all know that. Markets make, investors, what do? When a stock market bubble occurs, .com, for example, or the mortgage crisis bubble, and when it breaks and collapses, then everybody wakes up and says, oh gosh, I wish I'd known that it was a mistake. It shouldn't have been where it was. They recognize it and you go into a new reality. The same happens sometimes at major bottoms. A given market might go too low for too long, vastly underprice its own reality, bore the heck out of people who are looking at it, and they say, piece of garbage, I don't want to own that, and then suddenly it explodes up out of the hole, making up for the error it's made. I think we're on that situation with silver right now.
Look at base metals like copper and lead. Both spent decades range-bound before breaking out in the mid-2000s, copper in 2005-06, lead in 2007. After that, prices quadrupled in short order. They moved into a new reality, a higher plateau scaled up. Applying that analog to silver, it appears still trapped in its old 50-year range, while gold has left such a zone behind. The question, why hasn't silver made that leap yet? Is it market inefficiency, structural suppression, or simply an overlooked opportunity?
Nothing in terms of price momentum. In other words, normally we look at price charts, which everybody wants to see, but below it we do a momentum study of the price action by oscillating those monthly price bars or weekly in their relationship to a given moving average. Either they're above it or below it, therefore you could get an oscillator, okay? And it builds structures, the kind of structures that price chart guys look for. Triple top breakouts, downtrend lines broken, etc. Silver is totally green light in that regard. And we said that back in June When silver for a third time was coming up into the mid-30s, it had been to 35 in October last year and March of this year, dropped down to 27.5, came roaring up again, and we said when it got above 34, watch out, we're going to break out, but it's going to accelerate the angle of ascent. July, August, 4 months, we've gone from 35 to 53, and right now we're 47. What a percent move. It's such a momentum knew that. So from a price momentum perspective, there's nothing more to say. It's already positive. The key is silver spread relationship to gold, which has been over the decades, it's very low in relation to multi-decade levels. But it has a structure where you can look at that spread chart, which is divide an ounce of silver to an ounce of gold, express it as a percent. Right now, silver's like 1.2% the price of gold, which is very cheap.
Beyond raw price action, real insight emerges when you layer momentum oscillators, taking price bars, comparing them to moving averages, seeing if the monthly or weekly bars are above or below key levels. In this framework, silver has given a green light signal. The structure is there. A breakout above a defined threshold was flagged, and then the metal surged from the mid-30s to the 50s within months. That kind of velocity suggests the groundwork is done. The market now watches relational moves, not just absolute price.
If it breaks through that structure that we've defined, and in our reports we give you the exact number, and you close a month above that spread level, it's saying, I'm breaking out of my spread. When you go back and look at that explosion we had in late 79 to 80, where silver had already been going up for years, and suddenly it went berserk. It like quadrupled in 6 months. Or in late 2010, about 6 months before it hit its peak at 50, in April 2011, silver had already been going up for years, and suddenly it went berserk. It doubled in a half in 6 months.
Yeah.
If we do something similar, the thing that told you back then that it was going to go berserk was the spread. Silver was already full thumbs up, momentum-wise, but what told you that I'm going to lift the lid off in relation to gold? And it was the spread. It had similar structural ceiling on it. It broke through, and at that point, the spread said, I'm going to explode. We're facing that door right now. So that's the technical we're watching, not the price or the momentum of price.
Here is where the critical trigger lies, the spread. How many ounces of silver it takes to buy 1 ounce of gold. Historically, periods when that spread compresses mark big inflection points in silver's favor. Recent data suggests the ratio is in the 90 to 100 zone, still elevated compared to historical norms, often 40 to 70. Analysts point out that silver looks undervalued relative to gold right now. If the spread breaks higher, meaning fewer silver ounces per gold ounce, and remains closed above that level for a month, then the lid could be off. The chances of dramatic upside then increase.
Let's go back to gold to get a spread relationship. If you plot gold in relation to the S&P, since the year 2000, it's been very zigzaggy, but it's been net up dramatically. Okay, gold has beat over that 20-year period, October 2020, October 2000 to this October, 20 years. Gold's gone up like 16-fold. S&P's gone up 4.5-fold, which is the better place. Yes, there have been some big bear markets in gold, also the stock market, but net on balance, gold's beat. Now, however, since its 2011 peak in gold, its spread versus the S&P also dropped, meaning gold underperformed the S&P during its bear market, 2011, 12, 13, 14, 15. Starting in about 2015, if you plot the spread, divide gold, ounce of gold into S&P price, and plot it month to month, percent, you've been in a basing range where at the top of that range, the gold performance will surge up to a given level and stop, come back up to a similar level, stop, and has built a beautiful trend line going back 11 years with 4 pivot points hitting it. Intra-month this month, of course, we have, 3.5 days left, we've been out above that breakout point. We backed off hard last week, when we had the drop in gold and silver, and I don't know how we're going to end the month. But if the gold is 60% of the price of the S&P, it's a major breakout. It's telling you I'm gone. Okay, it's going to break out. Now, when that spread breaks out, the net price of gold it's just the beginning. That spread is telling you at that point in time when you break that spread out, and if it doesn't happen this month, it's going to happen soon. I can tell.
Yeah,
it's telling you it's a new game.
Yeah,
it's not an old trend. It's new.
Turning to gold's broader context, consider its performance versus the stock market. For example, the S&P 500 since 2000. Over the past 2 decades, gold has delivered a stronger net return than the S&P, but in the bear phases after 2011, gold underperformed. When you plot the gold to S&P spread over time, you see base-building structures emerge. A breakout in that spread implies that gold isn't just rising, it's entering a new game. And if that happens, the momentum for precious metals as an asset class shifts into a higher gear.
No, they don't. They create inflation ongoing. If you define inflation properly, which is the degradation of the increase in supply of money units, pieces of fiat paper that are worth nothing but the paper, if even that, whether you're talking yen, euros, or dollars, or other similar currencies that aren't backed by anything but government chest beating, okay? They're not worth anything. At least the tulip bulb mania, the tulip had some value, okay?
Yeah.
It was pretty in your garden, okay? But this is a piece of paper that decade by decade increases in quantity about 90%. Dollar M2, look at the M2 money supply, and go back to the 60s and then look on the Federal Reserve chart and see where it was in 70, do the math, 70 to 80, do the math, 80 to 90, etc. It's almost 90% every year increase in quantity, meaning its buying power continues down. When your granddad built a house, it cost $4,500. Your father had one, it was $45,000. Now it's $450,000 is the median home price. That reflects the degradation of the money in it, not the increase in the real value of a home. So gold constantly expresses, shows, reveals in its inverse way the ongoing degradation. So when the central bank says we're going to control inflation, well, if they did, they'd go to a backed currency unit and not print at the moment's demand. When something weakens that they don't want to weaken, they want certain prices to come down, but they don't care about stock market going up, inflated. They don't care about T-bonds being inflated. And so if something happens in those markets that they favor, then they'll print. And they always print. The only question is, to what extent? Is their pedal fully on the floor, or are they only pushing halfway on the pedal? You break that stock market, they'll push fully on the pedal. The problem is when they do that, 2000, 2002, 2007 to 2009, they pushed the pedal. It didn't save the stock market.
Underpinning all of this is the relentless expansion of fiat money supply. When the unit of account is being diluted, for instance via increased money supply growth, inflation isn't just a consumer price index story, it's the degradation of purchasing power. Gold historically expresses that degradation. When central banks print or push monetary pedals hard, real assets like precious metals benefit. Commodities more broadly, see the Bloomberg Commodity Index, now show signs of turning from supply glut to potential inflection. Inventories tightening, inflation threats rising. In this environment, gold and silver don't just run, they accelerate.
I think we're about to accelerate it again in a way that average guy notices. Now, admittedly, commodity prices, raw commodity prices, as in the Bloomberg Commodity Index, is not the full explanation of what CPI or wholesale prices are, okay? They have other metrics that they look at as well. But that's a heavy influencer. So if the price of beef, the price of gasoline, the price of copper, all these things go up, it's going to impact those even more, reflecting movement of money that they've created out of the paper asset category, the stock market, which decides I've overdone it, I'm going to go down, okay? That money flows, and when we do our analysis of the current Bloomberg Commodity Index, It's dancing this month on either side, and right now it's like 1/2 of a point below a massive monthly closing breakout level that says, I'm waking up again, meaning money is flowing out of what? Paper assets into real world assets because they're cheap. They've proven they're not going down anymore. They've been sideways for 2 years. And suddenly that's going to smack you in the face because not just gold and silver going up, but suddenly, oh my gosh, grain prices. Oh my gosh, gasoline's going back up because crude oil is. All these things will hit you. And that the Fed will have to, their two mandates. One is to try to keep that down. They can't opt that way because what's going to be happening on the other side of the equation, money flow out of the stock market and debt markets. They're going to have to answer that issue. They will shift to monetary excess again.